Welcome back to the channel. In this video, we'll start with the technical analysis of gold and then we'll dive deep into the fundamental forces driving the US dollar this week. By the end, you'll know exactly what direction gold is likely to move and where high-probability trading opportunities are forming. Let's begin with the technicals. Gold is currently trading inside a clean, parallel ascending channel, and price has been respecting this structure extremely well. Every time price reaches the channel support, it strongly rejects upward, confirming that buyers continue stepping in at higher lows. Recently, price pushed into the 4260 daily resistance zone, which is a significant historical rejection area. Gold reacted sharply from there, pushing back down into the middle of the channel. Right now, gold is still ranging inside the channel, but the structure remains bullish. We can clearly see higher lows developing, strong rejections from trendline support, stable bullish momentum building inside the channel. What we expect next is a deeper pullback into a major confluence area. The lower boundary of the parallel channel, the 0.5 Fibonacci retracement level, a previous strong support zone. This zone is the golden entry region for potential long positions. Once price dips into the 0.5 Fib plus trendline support, we expect strong buying momentum to return, pushing price back toward the mid-channel and potentially retesting the 4260 resistance zone again. As long as the channel structure holds, gold remains in a bullish trending environment, preparing for the next leg to the upside. Now let's move into the fundamentals, and this is where things get very interesting for gold. The United States is entering one of the most impactful macro weeks of the quarter, and the Federal Reserve is at the center of it all. 1. Monetary policy, Federal Reserve. The Fed has officially shifted into a dovish and expansionary stance, creating a powerful macro tailwind for gold. Last week, the Fed cut interest rates by 25 basis points and announced that quantitative tightening will stop in December. This combination is extremely important. Stopping QT means the Fed will stop shrinking its balance sheet, which prevents liquidity from being drained out of the economy. Lower interest rates plus no more QT equals massively easier financial conditions, weaker US dollar, and bullish environment for gold. But beyond the announcement, the tone from the Fed is even more dovish. The Fed highlighted rising downside risks to employment, slowing labor demand, and a willingness to ease further if economic conditions deteriorate. What makes this significant is that inflation is still above target, yet the Fed is already cutting rates. This tells us the Fed's priority has fully shifted toward protecting economic growth, not controlling inflation. Historically, gold rallies strongly when real yields fall, USD weakens, liquidity increases, and central banks ease policy. All of these conditions are happening simultaneously. 2. Global risk outlook. The global market environment is also supporting gold. Equities worldwide are rising, and the rally is broad, not just limited to tech and AI stocks. This indicates widespread investor confidence, which typically pressures the dollar and supports metals. A confident market environment weakens USD demand because traders rotate into global equities, commodities, and higher-yielding assets. This indirectly fuels gold's upside momentum. However, December is historically volatile. We have thin liquidity, year-end institutional rebalancing, multiple major global data releases, big central bank decisions back-to-back. This combination means gold can experience sharp spikes, fast retracements, false breakouts, but the macro direction remains bullish. 4. COT, commitment of the traders. The COT report is suspended due to the ongoing U.S. government shutdown. That means we do not have fresh data on large speculator positions, commercial hedging, and managed money exposure. However, historically, when the Fed turns dovish and yields fall, hedge funds increase long exposure to gold, commercial hedgers reduce their shorts, and asset managers accumulate gold as a defensive play. So although the report is missing, macro conditions strongly suggest accumulation behind the scenes. 4. The week ahead, key U.S. events. This is a central bank heavy week, and every release ties directly to the USD outlook. Federal funds rate decision. Any additional dovish tone, even subtle, will accelerate USD weakness, bullish gold. NFIB Small Business Index. If small businesses show declining optimism, hiring or investment, it strengthens the Fed's argument that the labor market is weakening. Weak NFIB means more easing pressure, gold bullish. U.S. unemployment claims. Rising claims signal labor market weakness. The Fed is extremely sensitive to employment data right now, so any increase strengthens the case for further cuts. More claims means weaker U.S. dollar, stronger gold. U.S. trade balance. A widening deficit often pressures the dollar due to increased capital outflows. This also supports gold momentum. Star final bias, technical and fundamental combined. Technical outlook. Gold is bullish inside a parallel channel. Expect a pullback into 0.5 fib and channel support, followed by a strong upside reaction. Fundamental outlook. Fed is dovish. Liquidity increasing. USD weakening environment. Global sentiment stabilizing. Macro risks supporting gold demand. Overall bias, bullish on gold. Watch for long entries at the deeper pullback zone and target mid-channel and the 4260 daily resistance zone.